Today we've increased bank rate by 0.5 percentage points to 4%. So obviously I want to start by explaining why we've done this. And I'm going to start with the outlook for inflation. Since the November monetary policy report, we've seen the first signs that inflation has turned the corner. Annual consumer price inflation has come down from 11.1% in October to 10.5% in December. That's below where we thought it would be in the November report. And we think it will continue to fall this year and more rapidly in the second half of the year. This has a lot to do with energy prices. Last year's very large increases are now beginning to drop out of the annual calculation of the Consumer Price Index. Moreover, wholesale gas spot prices have fallen by around 50% since November, and gas future prices have also come down markedly. But while external pressures are easing, other indicators of inflationary pressures have proved firmer than expected. The labour market remains tight by historical standards, and annual private sector pay growth increased to 7.2% in the 3 months to November, which surprised on the upside. As you can see in this chart, while core goods inflation has fallen, services consumer price inflation rose to a 30-year high of 6.8% in December, above what we expected in the November monetary policy report. Bank staff project that services inflation will rise further in the near term, consistent with the strength in wages and other costs facing service sector companies. It is price and wage setting dynamics in the UK economy that ultimately determine how long it takes to return inflation to target on a sustainable basis. So while we're confident that inflation will come down this year, developments over the coming quarters will be crucial in determining how quickly overall inflationary pressures abate. Judging sustainability requires us to look further ahead, and that's where the uncertainties increase. In the Monetary Policy Committee's best collective judgment, the most likely outcome is that an increasing degree of economic slack, alongside reduced external pressures, leads consumer price inflation to fall below the 2% target from around spring 2024 next year. Besides the market-implied path of bank rate, this is conditional on wholesale energy prices following their respective futures curves over the whole forecast period. So in other words, the forecast suggests that inflation will come down and that it will fall quite sharply. But events may not unfold in this way. With inflation currently above 10%, we are in uncharted territory. Energy prices may not fall by as much as currently expected in financial markets. And even if they do, this period of very high inflation could play into price and wage setting in the UK economy to a greater extent than we assume in our central projection. The tightness of the labour market reinforces this risk. For this reason, we think the risks around our central projection for inflation shown in this chart are skewed significantly to the upside, and more so than at any time in the history of the Monetary Policy Committee. Our decision to increase bank rate today, despite a weak outlook in our central projection, reflects these uncertainties. Uncertainties over the extent to which external and domestic inflationary pressures develop over the coming quarters, and wider uncertainties over the trajectory of the economy and inflationary dynamics further ahead. We have done a lot on rates already. The full effect of that is still to come through. But it is too soon to declare victory just yet. Inflationary pressures are still there, and we can see that in the data, and we hear it from our agents. And we need to be absolutely sure that we really are turning the corner on inflation. And that's why we've increased bank rate today. And that is why we will, of course, continue to monitor the data very carefully.